Hi everyone and welcome to this very exciting video. So this video is about stocks for the long run. So how to ignore the noise in the market that constantly goes on and how to make a game plan that will help you achieve your investment objectives. So this is a very interesting chart that I have found, and we'll start our discussions with that, and then we'll proceed to some key points from the book by the name of Stocks for the Long Run. Okay, so let's talk about the chart first. So this chart shows what happens if you invested $1,000 in the early 1930s, right? And just invested that amount of money. What would have happened if you invested in different things? Okay, so first of all, when you invest $1,000 like so many years back, 70 years back, right, or more than that, 80 years back, right, inflation would act on it. So this $1,000 will not be $1,000 today. So if you inflate it by the inflation rate over the years, so each year the inflation rate was different. Sometimes it was higher, like the chart shows. Sometimes it was lower in the last 20-30 years, right? It is again ticking up higher. So if you adjust that $1,000 with regards to inflation, that will be somewhere around $19,000 today. Average rate of inflation during this period since the 1930s to 2021 has been around 3.5%. So this $1,000 would become 19,953. You have to put that in context because your investment has to grow at least by the rate of inflation. Okay, this is very, very, very important. Now, if you started investing and you invested in T-bills, T-bills are short-term government bonds, right, that you can buy. So if you invested in T-bills and just kept the money in them, right, T-bills generally have performed better than the inflation. There were periods of history where inflation rate was higher than T-bills. Like right now also inflation is higher than the returns on the T-bills. But overall, T-bills had an return rate of return that was higher than the inflation. Highest T-bill return was 22.75%, right, in the 1980s when the inflation rate was very high, and to counter that, the interest rates were very high. So you would have received $36,415, right, if you invested in T-bills. So effectively, you have kept up with purchasing power because your $1,000 invested is more than the inflation. So kudos for you. Now, if you invest that $1,000 in bond and just kept the bonds throughout, so government of US or government of Canada, long-term bonds. So what will happen? So the bond portfolio will become 115,000, right? 136. The average return is around 5.9%. So your bond investments would be way higher than the inflation rate. Okay. Then if you invested in a combination of bonds and stock, income portfolio, right? Focus on dividends, focus on stability, focus on bonds. Your portfolio will be $347,000, right? 7% average returns over the last 80 odd years. Sometimes it's higher, sometimes it's lower, but on an average, stable growth. Okay. Now comes the interesting part. If you invest in international stocks, right, the portfolio will grow to around $1 million, 980,000 to be very precise. Now you can see international stocks did not do well in the war period. So 1940, 1950 was the war time. So European markets were shattered, the Asian markets were shattered. Then they did okay for the remaining years. Then again the Asian crisis, the Gulf War happened. Then let's say Gulf War reduced the returns on international stocks. Then there was the Asian currency crisis that also reduced the returns on international stocks. So various crises, right? But if you kept your investments in, you would be around $1 million in international stocks, 8.2% returns over the last 80 odd years. If you invested in a balanced portfolio, US focus stocks, right, growth value both, as well as bonds, you would be around 1.1 million, right? 8.5% return. If you invested in Canadian stocks, your value would be around $3 million, right? Great returns. 9.7% is the average compounded return if you calculate from for the last 80 years. If you invest in growth portfolio, it will be 10%. Growth stock means like highly risky stocks, highly speculative stocks, Googles and Apples and all of that. So your returns will be 3.843%, higher than Canadian stocks, because Canadian stocks are more value based. They have always been more value based. Okay. And if you just invest in the US stock index, right, the S&P 500, and forgot about it, right, for the next 80 years, your value will be around $14 million, because US stocks have performed the best amongst the world, and the returns has been 11.7% return. Okay. Now this whole period, like, you would be wondering, we are in a crisis now. We have COVID, we have inflation, we have so many crises. But this whole period considers 2 world wars, right? It considers, right, a pandemic, the influenza pandemic before that. So returns were depressed before we started the period. It considers the Gulf War, it considers Vietnam War, Black Monday crash, the Iraq War, the WHO emergency, right, the COVID-19 pandemic, life expectancy changes, downgrades, etc. So it considers like lot of calamities. It's not that the world hasn't faced any dangers before this, right? We have human beings are capable of bending the arc towards the betterment of our species. That is always true. Like, the generation today is better off than the generation before, and this continues, right? Because of innovation, because of tech, because of human ingenuity. So a lot of factors play a role. And if you invested, you would have faced downturns like 42% negative returns in the 1930s, 27% negative returns for 7 months during the early 1950s. Then 1970s was the lost decade for stocks. Stocks didn't do that well. So 25% negative returns, 35% negative returns. At the start of 1980s, negative 39. So a lot of big drawdowns. But over a period, if you kept invested, right, if you didn't pull out your money, you should be, right, better off in the long run. So this is the big picture. Staying with stocks for the long run has historically been very rewarding, irrespective of the market situation, irrespective of the economic situation. Because when you invest in the overall stock market, overall global economy, let's say, you are investing in the humankind. You're investing in like humankind's potential to innovate, humankind's potential to thrive in spite of a lot of hurdles. Okay. Now, next in this video, we are going to review an excellent book called as Stocks for the Long Run. It's an excellent book. If you get time, read it, but I'm going to highlight few important points from that book. So the first is how to measure risk. So how you define and measure risk is very important as an investor. So Siegel, the author who has written the book Stocks for the Long Run, effectively shows that in the short run, stocks are very risky, and you can and will get some very nasty price moves against you. So you will probably see a lot of drawdowns, 20%, 30%, in bad years as much as 50% drawdowns on your investments. So the author highlights that in the long run though, stocks are the least risky asset class. Stocks have been the best performing asset class in every 30-year period that has been analyzed. So if you take a chunk of 30 years, right, irrespective of which year you start, right, it can be shown that stocks have performed the best in that 30-year chunk. So 30-year is why 30-year is important, because that is the effective investment horizon for a person. Because you start investing, you invest for 30-35 years, and then you take retirement and you live off of that. Therefore, if you have a long-term horizon, it would be not risky actually to be in stocks. As an individual investor, you can have huge advantage over professionals because you can afford to take much longer term view. Professional investors, especially hedge funds and stuff, they have to generate returns every year. As an investor, you don't. You can wait on it. So that's an edge that you should always focus on. Professional investors such as fund managers are typically measured on year-to-year basis, and as Siegel shows, the author shows, year-to returns in the stock markets are very volatile. As a long-term investor though, you can afford to be much more patient, allowing you to sit through volatile times and therefore not be tempted to sell at silly times. So your patience is your edge. If you can be patient throughout market turmoils, ignore the noise, whatever is going on, and stay on with your vision, you should be okay. So, what are the myths of economic growth and returns? So, when you ask people where they are investing, they will often answer that they need to be in high growth areas or high growth countries. Logically, this makes sense. As investors, you want to see growth and feel you should be reflected in your returns. But the author shows in Stock for Long Run that surprisingly, these high growth sectors of the market do not provide the highest return for investors. There are two main reasons. High growth sector or the countries tend to be very pricey. So you have to, like, in terms of valuations, in terms of price you pay to buy is very high. So that automatically prices in the growth and often leads to overvaluation. This future returns is therefore below average. High growth economies or sector often need to issue a lot of new stock to feed this growth. This leads to more and more capital pouring into these sectors that can dilute existing shareholders and lower the return. So if you unpack this, it means do not go for hype. There would be like a lot of hype stocks. There could, like, for example, last 20 years Apple has done really well, Google has done really well, but we do not know about the next 20 years what they would do. So instead of investing in or cherry picking particular stock or particular sector or particular stories, right, or particular countries for that matter, for example, a lot of people were very bullish on China, right? China did quite well from, if you see, 2008 to 2019, but after that Chinese returns are lagging. In fact, the Chinese returns on especially Chinese tech stocks, those were the growth drivers, the Alibabas and Tencents of the world, have not done so well in 2022. Okay, so things change, stocks change, stories change. So rather than being invested in those like in specific countries, in specific stocks, you have to take the broader view and invest in overall market as a remedy for this. So there is an importance of being global. According to Siegel, US market constitutes less than half of the world's total equity. Why restrict yourself to one country when you can invest all over the world? Some of the best companies, for example, Unilever, Diageo, Nestle, Sanofi, are based outside of US. And this is like a trend, like demographics are destiny. So if you look at different demographics around the world, so demographic means which countries have lot of young population, because young people consume, young people learn, young people learn new skills, young people found new companies, so all the buzz happens around young people. So if you're investing, like, demographics could be a good, like, factoring. So let's say India has good demographics or Africa has good demographics, so potentially these markets could do well, but we do not know that. So instead of taking a specific view, invest everywhere. You may think to yourself that US has been the best place for return. Not so according to Siegel, who traced past total dollar returns in several developed countries, and returns are quite similar. So if you consider the whole 19th century and beyond, including the 20th century, returns in Sweden, Australia, South Africa, right, are similar to what they have been in US. So instead of investing in a country, right, invest in the whole market. Many other countries such as Denmark, New Zealand, Canada have dollar returns very close to US over that 112-year period. The author argues in Stock for Long Run that foreign markets has never been more accessible for domestic investors and opens up huge pool of opportunities. There is no need to analyze the local opportunities. Okay. Now, that was the third thing, that instead of investing in a specific country, try to invest more broadly. That's what the author argues on. Knowing where the shareholder value comes from and how to outperform the market. The author devotes an whole chapter to the sources of shareholder values and where your long-term returns are going to come from. We think it is very important to have strong understanding of returns are generated and how value of both current and future dividend is the key of valuing stock. This does not mean that if a company doesn't pay any dividend, then it shouldn't have value. For example, right, what is important is the company's capacity to pay dividend. So dividends are very important. Even if the company is not paying dividend, you have to factor in what is the free cash flow for the company. If the free cash flow for the company is really good, it means that it is choosing not to pay dividend, but if it has to, it can pay a lot of dividend. For example, in the book, the author discusses Berkshire Hathaway, which has famously not paid any dividend since 1968, but has the capacity to pay dividend, right? And that capacity has gone up enormously since then. So the company is valued much higher. Understanding the sources of shareholders' value helps you in your ability to value the underlying stock and understand how companies' action are going to help you to create returns. Okay, so importance is good companies that pay you decent amount of dividends. The fifth point that the book highlights is importance of behavioral finance and psychology of investing. This is the most important thing. Investing in the long run is not about aptitude, it's much more about attitude. So the stock market can be a very dangerous space. So there is a chapter about behavioral finance and how you can avoid common mistakes. It is easy to forget that the stock market dropped by nearly 90% between 1929 and 1932, and as recently as 1973 to 74 the UK market dropped by almost 75%. Despite these large drops, the 20th century was a wonderful century for stock market, and it is important for you to understand that the market and the headlines will be very volatile. So this is the key. You can have and you will have, when you are invested for the long time, you will have large drawdowns in your investments. This is just part of the game, right? If you invest for the long period of time, it is inevitable you will see large drops, scary headlines, biases, overconfidence, and bubbles. Your job is to try to recognize these risks and avoid the temptation to take action that won't make sense in the long run. So staying invested, investing regularly, and dealing with like bubbles and bust is very important. We urge you to focus on the underlying businesses you own and consistently try to purchase good quality profits at reasonable price. That's the key. Buying good companies at reasonable price if you're a stock investor. If you don't spend a lot of time studying the market, then consistently purchases of market like S&P 500 or through an index tracker or an ETF should do well over a period of time. So what's the summary of this video? If you have to recap in 4 points. So first point, try to invest 10% of your regular income into the broad global diversified stock ETF. So you can have combination of two ETFs, XIC, which is the Canadian ETF, put some money in that, and XAW, right? XAW is the global ETF minus Canada. So if you combine the both, you get the whole world, right? So investing in something like that, investing in ETFs that have broad exposures help you. 10% of your income, no matter what, if you keep on investing, you should be okay in the long run. The key is invest regularly. Come high, come low, markets up, markets down. If you keep patience, if you keep discipline, right, markets reward you in the long run. Stay in the market to outperform the market. If you're just in cash and not invested, right, it is not going to make you any returns. There are points of having larger cash allocations in the portfolio. When you think that the market is overpriced, you can time the market, right? But some part of your investment should be regular and like be in the overall market. And finally, most important thing, ignore the noise. Markets will have drawdowns, market will have bubbles. Just ignoring the noise helps you to stay on track for your investment goals. Thank you for listening. See you in the next video.